A surprising shift in the Federal Reserve's tone has sent shockwaves through the stock market. With expectations of a dovish stance dashed, investors are left reeling. Here's the detailed breakdown of today's significant events. As we look to the future, several scenarios could unfold in the wake of the Fed's hawkish shift. The Federal Reserve's recent decision to maintain a vigilant stance on interest rates has sent ripples through financial markets. The immediate focus will be on upcoming inflation and labor data, which will play a crucial role in shaping market expectations. Historically, inflation trends have been pivotal in guiding the Fed's monetary policy, and any signs of persistent inflation could solidify the central bank's commitment to higher rates. If these data points support the Fed's current caution, we may see a sustained period of elevated rates, which could further influence market dynamics by increasing borrowing costs for consumers and businesses alike. Conversely, weaker inflation indicators could prompt a reassessment of the Fed's stance, potentially leading to a more dovish approach that could invigorate market sentiment. Experts are closely monitoring Treasury yields, semiconductor stock performance, and whether the rebound witnessed on Thursday can hold. Higher rates typically lead to lower bond prices, affecting investor sentiment across various sectors. The next few weeks will be critical as investors gauge the market's response to the Fed's new policies. With uncertainty ahead, one pressing question remains: how will investors adapt their strategies in response to a potentially prolonged period of higher interest rates? Market analysts suggest that sectors such as technology may face headwinds, while financial institutions could benefit from wider interest margins. As the Fed's decisions unfold, companies may also revise their capital expenditure plans, impacting economic growth projections. Investors will need to remain agile, adjusting their portfolios to navigate this evolving landscape. The upcoming economic indicators will prove vital in determining the Fed's next steps and ultimately the trajectory of the markets. Leading up to this pivotal moment, market sentiment had been largely optimistic, with many investors positioning themselves for a relatively neutral or dovish approach from the Federal Reserve. This optimism was fueled by earlier indications of a stabilizing economy and lower inflation expectations. However, the Fed's decision on June 21st took the market by surprise. While the hold on rates itself was anticipated, the accompanying tone and updated rate projections were not. The shift from a dovish to a hawkish outlook reflects a growing concern regarding inflation and economic resilience. In the weeks preceding the announcement, analysts noted a steady decline in inflation rates, which led many to believe that the Fed would continue its accommodative policies. However, the Fed's unexpected hawkish tone ignited fears of prolonged interest rate hikes, triggering a broad sell-off in equities. This situation echoes past instances where shifts in Fed policy caused swift market reactions, often leading to increased volatility. Investors are now reassessing their strategies, weighing the implications of higher borrowing costs against the backdrop of a resilient labor market and consumer spending. The immediate impact of this shift has been felt across various sectors, with technology and consumer discretionary stocks experiencing the most significant declines. As investors grapple with uncertainty, the market's trajectory remains precarious. Looking ahead, analysts suggest that the Fed's hawkish stance could persist as inflation remains a pivotal concern. The central bank's next moves will be critical in shaping economic conditions. Investors must stay vigilant, as further adjustments in monetary policy may lead to heightened volatility and require strategic recalibrations in investment portfolios. The coming months will be crucial as the market adjusts to this new economic reality, with all eyes on the Fed's next meeting. The Federal Reserve's unexpectedly hawkish meeting in June has sent ripples through financial markets, signaling a more aggressive approach to monetary policy that could have far-reaching consequences. The central bank's decision to maintain elevated interest rates for an extended period reflects its unwavering commitment to combating persistent inflation that has plagued the economy. This shift emerges amidst ongoing economic recovery efforts where inflationary pressures have remained stubbornly high, driven by supply chain disruptions, rising consumer demand, and geopolitical tensions affecting global trade. For investors, this hawkish stance alters the landscape significantly. Equity valuations, particularly in the growth and technology sectors, are especially sensitive to fluctuations in interest rates. Higher borrowing costs can compress profit margins and deter investment in these high-growth areas, leading to heightened volatility in stock prices and potentially stalling innovation. Additionally, the increased cost of borrowing extends beyond equities. It influences various financial instruments, including bonds, mortgages, and corporate financing, which are intricately linked to consumer behavior and business investment decisions. This environment could dampen risk appetite small, prompting investors to reassess their portfolios and consider safer assets like treasury bonds or gold. The Fed's shift also alters market expectations regarding future monetary policy, especially concerning the timing and magnitude of potential easing measures. Investors are now more cautious, recalibrating their strategies in light of the central bank's new trajectory. This recalibration is not merely an abstract exercise. It has tangible implications for everyday Americans. As interest rates rise, the costs associated with loans and credit also increase, directly impacting personal finances. Consumers may find themselves facing higher monthly payments on mortgages and credit cards, which could reduce disposable income and, by extension, consumer spending, an essential driver of economic growth. Looking ahead, the implications of the Fed's decision are profound and complex. As the central bank continues to navigate its dual mandate of fostering maximum employment while ensuring price stability, the balance it strikes will be critical. The potential for prolonged elevated interest rates may temper economic growth, challenging the recovery. Investors and consumers alike must remain vigilant and adaptable in this evolving economic landscape. In the coming months, attention will center on how these monetary policies shape financial markets and consumer behavior, particularly as inflationary pressures persist. On June 21, 2026, the Federal Reserve convened for its highly anticipated June meeting, where it decided to maintain the federal funds rate at its current level. However, the real shock emerged from a significant shift in the Fed's outlook, as reflected in the updated dot plot. This dot plot now indicated that 9 out of 18 Fed officials foresee at least one rate hike by the end of 2026, a stark change from previous expectations. This alteration in the Fed's tone, alongside its decision to eliminate any easing bias, triggered immediate turbulence in financial markets. Following the announcement, the Dow Jones Industrial Average plummeted over 500 points, marking a sharp decline that sent ripples through the investment community. The S&P 500 also felt the brunt of this news, experiencing a decline of 1.2% as all 11 sectors closed in the red on Wednesday, reflecting widespread investor concern and uncertainty. Contextually, this shift in the Fed's outlook comes amid a backdrop of persistent inflationary pressures and a labor market that remains robust. Inflation, which has been hovering above the Fed's target rate for several months, has become a significant challenge for policymakers. The central bank's recent policy adjustments signal an increasing commitment to curbing inflation, which has been a growing concern for economists. Investors had been hoping for more dovish signals, but the Fed's hawkish turn has forced a reevaluation of future monetary policy. In the aftermath of the Fed's announcement, the markets began to recover slightly on the next trading day, Thursday, June 22nd, as investors reassessed the implications of the Fed's decision. Notably, there was a significant rotation into semiconductor stocks, which helped major indexes regain some of their losses. This response indicates a complex market dynamic, as participants navigate the balance between growth potential in certain sectors and the overarching threat of rising interest rates. Looking ahead, market analysts will be closely monitoring economic indicators, particularly inflation trends and employment data, as these will heavily influence the Fed's decision-making process. If inflation persists, further rate hikes may be inevitable, shaping the investment landscape for the remainder of 2026 and beyond. Investors will need to stay agile in this evolving environment, as the Fed's policies could have lasting implications for economic growth and market stability. As we consider these developments, how will investors adapt their strategies to navigate potential prolonged higher interest rates? Share your predictions in the comments below and subscribe for more daily deep dives.